Welcome to This Explainer. Okay, so you've got the vision, right? You've pulled those late nights, sketched out concepts on napkins, done the endless whiteboard sessions, and you've got a business plan that you just know deep down is going to totally disrupt the market. But here's the thing, turning that wild, ambitious idea into a living, breathing, profitable reality, yeah, that takes more than just passion and a clever concept. It takes fuel. Without capital, even the most brilliant strategies are literally just words on paper. So today, we're diving straight into the foundational mechanics of business financing. We'll break down exactly how modern founders secure that absolutely crucial early-stage cash, how they strategize their growth, and ultimately how they decide the future trajectory of their entire company. Here's our founder's roadmap for today. First, the $0 dilemma. Then, step 1, debt financing. Step 2, equity financing. After that, we'll be comparing your funding options, and finally, scaling to $1 million.
All right, section 1, the $0 dilemma.
Let's put you right in the shoes of a brand new founder for a second. Just imagine you've mapped out the absolute perfect business idea. You know your target demographic inside and out. You've got a flawless solution to a major problem, and man, you have the burning drive to actually execute it. But there's a massive roadblock. You have exactly $0 in the bank to buy inventory or build the software or market your brand. It's paralyzing, isn't it? Well, this is the very real, very frustrating dilemma that stops thousands of potential entrepreneurs right in their tracks before they even get to the starting line. You've got the blueprint, but absolutely zero bricks to build with.
But fortunately, you don't need to be independently wealthy to build an empire. And that's exactly why business financing exists. It's so vital to understand that outside capital, it's not a crutch for a failing business. Actually, scratch that. It's more like deliberate, strategic leverage. By utilizing other people's money, founders can drastically accelerate their time to market. I mean, think about it. Almost every massive industry-defining company you interact with today started at this exact same square one. They relied on external financing to skip the impossible hurdle of bootstrapping from nothing.
So fundamentally, business financing is simply the process of getting money to start, operate, or grow an enterprise. Think of it as a highly versatile tool in your founder's toolkit. When you're at day one, financing is the seed money that gets your doors open in the first place. When you hit a seasonal slump, it's the operational capital keeping the lights on. And when you're finally ready to take over a new market, it's the growth capital that funds that expansion. It really is the lifeblood of the entire business lifecycle.
Moving on to section 2. Step 1, debt financing.
Okay, so when seeking that initial leverage, founders generally look down one of two main avenues. The first one is debt financing. This basically involves borrowing money from a bank or an institutional lender. The mechanics here are pretty straightforward. You get an immediate cash injection today to solve your $0 dilemma. But, strategically speaking, debt is kind of tricky. That money has to be paid back eventually, and it comes with a recurring cost called interest. And because of those mandatory scheduled loan repayments, taking on debt demands that your new business has a highly predictable, steady cash flow right from day one. Because if you don't, you risk defaulting on the loan.
However, debt financing comes with one massive, unparalleled advantage for a founder. You keep full control of your company. You don't have to surrender a single percentage of ownership, and you don't have to give anyone else a seat on your board of directors. You answer to literally no one regarding your day-to-day operations or your long-term vision. But remember, it's a double-edged sword. Keeping 100% of the company also means you're bearing 100% of the financial risk if the business goes south.
All right, section 3. Step 2, equity financing. So the alternative route here is equity financing, which basically bypasses the bank entirely. Instead of borrowing money, you sell a portion of your ownership to investors in exchange for capital. Now, the immediate massive appeal here is that there are no required monthly loan repayments draining your startup's fragile cash reserves. If the company fails, well, you don't legally owe the investors their money back. But the strategic trade-off here is permanent dilution. You're giving up a permanent slice of the pie. That means permanently losing a fraction of all your future profits and often giving up a certain degree of voting power and control over the company's direction. It's essentially a business marriage.
Section 4. Comparing your funding options.
Every single founder ultimately arrives at this critical crossroads. It's the ultimate balancing act, right? Keeping full control while taking on the pressure of interest payments versus enjoying debt-free cash while sacrificing ownership and future profits. The smartest founders know that the right choice depends entirely on your specific business model. For example, say you're opening a local coffee shop. You've got tangible assets, predictable daily revenue. Debt financing often makes perfect sense there because you can reliably cover the interest. But if you're building a high-risk, high-growth AI software startup that won't see a dime of profit for 3 years,
Debt will absolutely crush you. In that scenario, equity financing is essential because you need that long-term runway without the burden of monthly loan repayments.
And finally, Section 5, Scaling to $1 million.
Once you've strategically chosen your financing path and, secured the bag, it's time to turn that abstract capital into aggressive growth. Imagine utilizing that newly injected cash to immediately poach a brilliant, highly sought-after lead developer away from a competitor. Or maybe you use the funds to buy top-of-the-line servers to handle massive user traffic. You finally launch that polished product you've been dreaming of, and you back it up with a heavy-hitting marketing blitz that expands your brand into global markets. The capital is the exact fuel that transforms a tiny, localized idea into a massive, scalable operation.
Reaching a massive milestone, like your first $1 million in revenue, that's rarely an accident of timing or pure luck. It's the emotional and financial payoff of understanding leverage early in the game. It is the direct result of a founder looking at their unique business model, anticipating their cash flow needs, and making the exact right strategic choice between debt and equity to propel the company forward. So you have the blueprint. You understand the leverage. Now here is the big question. Which financing path will you choose to fund your $1 million idea? Will you retain total control and brave the pressure of debt, or will you share the pie to build a massive war chest of equity? The strategic choice is entirely yours. I hope this explainer gave you a really powerful framework for navigating those early founder decisions and leaves you fired up and ready to tackle the exciting challenge of building your own empire. Keep learning, keep building, and we'll see you next time.